everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host tonight, as with every Tuesday night here at Zoom at 8. I am a premier provider with Old Capital Lending. We provide lots and lots of multifamily operators lending for their multifamily. We do this across the nation. We will do other asset classes like mobile home parks, like retail office, any of the other asset classes, but we really are specialists in multifamily. So if you are looking at a deal, if you're looking at trying to figure out, does this work? Can I get lending? I would love to have the opportunity to earn your business as your premier provider of debt. All you need to do is send me over your T12, your rent roll, the OM, which is your offering memorandum, even though many times it has a bunch of garbage in it, and the underwriting, something that you're seeing how you're going to operate this over the next 5, 6, 10 years, however that is. There are lots of models out there, and we can certainly highlight some of those tonight with our speaker of the night. I'm telling you, guys are up for an amazing evening. David Monroe, CCIM, is here tonight. He is a black belt consultant. He is amazing. So David Monroe is like me. He says it like it is. And some people don't like that. So you're up for such a wonderful evening tonight. I have known David for probably 3 years. And David, I was immediately motivated, if you will, by his frankness. David Monroe is a multifamily investor, strategic consultant, CCIM instructor, and specializes in multifamily investing, market analysis, finding off-market opportunities, and teaching real estate professionals that rely on real estate transactions for income. Since January of 2021, David has been building his consulting, education, mentoring, and coaching program to help multifamily investors get their first or next deal. Over the last couple of years, David is now taking what he's learned from his company and sharing it with real estate professionals to help them survive the coming recession. We've got to know more. So David although I think you're always a United States Marine, but he retired after 11 years, 4 months, and 16 days. But who's counting? They really instilled his core values, which are honor, loyalty, and integrity. His passion and focus is to help as many real estate investors, agents, and brokers succeed in this very competitive industry and not have to rely on income from transactions alone. So it is my great pleasure. And everybody, you are going to need a piece of paper and get dialed in for tonight's guest. He is spectacular. David Monroe, CCIM, welcome to Zoom at 8. How are you?
Good, Julie. Thank you so much. What a wonderful introduction. I have a real quick slide when I get to my little pieces. I've got some things I want to do on some websites so I can show some data. And I've got just a quick slide deck on how to look at market cycles, because it's really, really critical right now with where we are in the market. And then we'll jump into CoStar and we'll look at Dallas and see what we see once we learn about how to identify market cycles and see if Dr. Muller's new fourth quarter market cycle report is accurate. And I think we're going to find it's dead spot on. But first, I guess it's okay. I can share my screen.
Yeah, you can share your screen, but before you do that, I want everybody to go up to the right-hand side, find the little 9 dots, and give us the speaker view. You probably see me. And I want to know, for the people that are in the room and watching, obviously, what is CCIM? Can you give us an understanding of what that is? How long does it take to get this certification? And why would someone want this? Is that something that you can share with us?
Absolutely. So a lot of people will ask me, where can I get the best education? And I own an education company, and I do not tell them me. I tell them CCIM. And because everything I teach from the fundamentals of CCIM. CCIM stands for Certified Commercial Investment Member. They are an affiliate of the National Association of Realtors, but they're actually only about 66% brokers. They're syndicators, developers, attorneys, appraisers, lenders, all different walks of life that are in commercial real estate that belong to CCIM Institute that are in investment real estate. We are known as an education organization, and we provide the curriculum for postgraduate degrees in 135 of our universities across this great country. So as a CCIM instructor, we have over 13,000 members at CCIM. There are only 60 instructors. I happen to be one of them. I teach market analysis. And so when I talk about markets and I talk about market cycles, it's not my ideas. It's not my training. I'm teaching the fundamentals that I teach at CCIM Institute without giving away their curriculum, if you will. So
you mean you haven't been just doing this for a couple years, and you ended up getting a whole bunch of acquisition fees, and now you're the professional guru.
Right.
That's not what you are.
Nope. I teach fundamentals. So one of my taglines is data-driven approach. We don't guess at anything. And I'm sorry, guys, and I know a lot of you are going to take offense to this. When you buy on pro forma, you're guessing. If you do not do a feasibility analysis, you are guessing. So market analysis is a must. So I'm a big proponent of that. All right. So that is CCIM, CCIM.com. It is the premier education for commercial real estate investment principles. Doesn't matter if it's retail, office, industrial, multifamily, hospitality, mobile home parks, RV parks, self-storage, any commercial real estate investment, including multifamily portfolios. And now, of course, the build to rents are built into that as well.
So how long is that program?
Well,
how much does it cost?
It's about $1,500 a class. If you're a member of the Institute, you get discounts. You also get free access to Site to Do Business when you're a member of the Institute, which is a tool that ESRI built for us. Esri out of where they're in San Bernardino, California, not too far from you, Julie. Mm-hmm. Just up I 15. Mm-hmm. I grew up in California, for those that don't know that. Mm-hmm. Shh, don't tell nobody. There's 4 core courses: 101, 102, 103, and 104. 101 is financial analysis, where you actually learn all the definitions and the acronyms, the financial models, the discounted cash flow, time value of money, all that stuff. 102 is what I teach, market analysis. 103 is user decision analysis. So if you're going to own or occupy the building, or if you're going to lease a building as a business, that is a user decision analysis. And 104, I like to call 101 on steroids, which is investor decision analysis. So you don't occupy the building, you lease the building to somebody else as an investor. Those are the 4. We also have negotiations and a whole bunch of other ward courses, which I happen to be the chair of the Ward Center Committee this year. And I teach one of the ward courses, building a consulting or investing business as a broker. So CCIM.com, go to education, you'll find all the courses.
So all that to say, we're working with a professional. This is real information, not stuff that has been validated, right? It's not because he became rich quick. So right. Really important.
I'm still not rich. So
well, it's rich in love. So right. David, what is the cost for that, and how long does somebody take to do that?
It took me 5 years.
Okay.
From start to finish, from the time I took my very first class until the time I got designated, because you also have to have a portfolio of experience. Now, real estate syndicators, you can get your portfolio pretty quick. There is a 3 minimum transaction that has a value of at least 30 million accumulative. You can get that pretty quick syndicating. Otherwise, it's 10 transactions at 10 million accumulative, or 20 transactions with no accumulative dollar value. So there is a level of experience. You have to be full-time real estate investing or brokering or it just be a real estate professional full-time for the last 2 years before you can get designated. Those are the requirements. So it takes, I've seen people do it as fast as, well, the fastest I've ever seen is 8 months. And the longest I ever saw was a guy out of Phoenix. I don't know if any of you know, oh crap, now I can't remember his name. Anyway, he's with Sperry in Phoenix. Neil, what's Neil's last name? Neil Sherman out of Phoenix. He's a brand new CCIM. Took him 23 years.
Wow, what a success story that is. Very proud.
Neil's an interesting character, but
yeah.
In any case.
And what's the cost for this? And then we'll get going.
Well, it's about 50. It's 650 a year or 675. They just bumped it up a year to be a member. And each class ranges between $1,500 and $1,750.
Okay.
And then the smaller classes at Ward Center are as low as $110 to as much as $435.
And so the total package to get it all done for your...
I spent, because there's some travel involved. You got to take a final exam. There's a final course before you take the final exam. You can only take the exam twice a year. You got to travel to where we have our conferences. We just had it in Boston in April. We're doing it in Seattle in October. So you have to travel to those locations to test. So all in, it cost me about 15 grand.
Great. Okay, perfect. I mean, that's very reasonable compared to the 50, 60, 70, 150 mastermind. So for everybody who is new here, I highly recommend you take a look at this. So David?
And learn the fundamentals, not tactics, because tactics will only last in a certain market cycle. And I can tell you right now, all the tactics that the gurus have been teaching in the last 4 years are now over. And if you're still investing with those tactics, you're going to be in trouble. And I'm about to prove to you why.
I can't wait.
Okay.
Turn it over to you. We are ready.
So obviously multifamily is my passion, but this is what I love to do to have fun. Okay. That's my baby. That's my rat rod. Unfortunately at the moment, if I close that, the motor is sitting out on the floor right now and I'm rebuilding her. So, I got all my pieces and parts. She's going back together, but I can only work on her a couple of days a week. So still building her back up. I upgraded it to a 347 stroker. All right. Enough about that. I want to start with an email I got. This from a lender, Julie. You ought to get a kick out of this. And I'd love your input.
I just saw this. You
saw this too. Did you get a good laugh at it like I did?
I did. I had to look at it a couple times. I was like, what is going on here?
Right. So, 250 units. Doesn't say who the sponsor was. Thank God. This is a vacant property in Jackson, Mississippi. If you know anything about Jackson, Mississippi, it is not the nicest part of Mississippi. I don't know where this is located. I have not looked this property up. Okay. Loan amount of 11.9 million, 250 unit vacant property. 11.9 million loan amount, 2.54 million rehab budget. Loan to value at 62%, 24-month interest only. At least, hopefully, it doesn't say here, they got their fixed rate interest only. I don't know if they did or not. It doesn't say whether they did or not. Doesn't mention here.
Yeah, that's all they have. So, yeah.
Okay. Yeah, and we don't know what the interest rate was. Any idea what the interest rate was?
Around 10.
Yeah, I was going to assume a 9 or 10%.
Yeah.
Right. 24 months at 10%. Okay. Totally vacant. You're paying $77,000 a door. Bridge financing, 24 to 36 month term with extensions available. Julie, are extensions mandatory?
No, they are not mandatory.
That's a big misunderstanding in the market, that you get this 3+1+1. That +1 is optional, folks. It is not mandatory. If your DSCR is not where it needs to be, you're good chance you're not going to get your extension. Okay. But we'll talk about that in a second. I just wanted to pull this up because this is the kind of stuff we're seeing right now. Hopefully everybody here agrees that this was probably not a good deal. If this is your property and you're here, I apologize. Please do not raise your hand, because I'm probably going to attack you a little more and find out why you did this. But this would be considered a deal that's going to be at risk very quickly. And there's some reasons why. So I'm going to pull this up. I got to minimize this. And Julie has not seen these, so this is new to her.
No, yeah. There we go.
Okay, so these are my slides, very few. This will be real quick. So real quick disclaimer, I'm not an attorney nor a CPA. I do not play one on TV or pretend to be one in real or imaginary life. This material is for educational purposes only and should be considered advice. Consult your own attorney and or CPA for such advice. So we've covered this pretty extensively already. I'm a multifamily investor and strategic consultant. I teach market analysis for the CCIM Institute. I am on the tech board, which is Site to Do Business, CCIM Tech. I am the VP of marketing for the tech board. I am a foundations board member, which is the capital raising arm of the CCIM Institute. I am the Ward Center Committee Chair this year, which is another education arm of CCIM. I'm the founder of the strategic partnering community. I noticed about 4 or 5 of our members are currently in this meeting. I'm a former syndicator, now passive investor, and I, at one time, owned a property management company. One thing I learned about owning a property management company is I learned that there actually is a business that has smaller margins than restaurants.
Mhm.
Take that for what it's worth. Okay, so this just kind of depicts what everybody's feeling right now. If you're not feeling this, you're not paying attention to what's going on in the market. It's a little chilly out there. The deals are slowing down. Cap rates are rising. Rents are declining. NOIs are declining. Expenses are still going up. And with interest rates going up, if you didn't get a rate cap and you have a variable rate loan, we can have that conversation later on why you did that. You're feeling the pinch. It's a little chilly. And it's going to be extremely cold, and icicles are going to be forming for any of those that have bought since the end of COVID up through 2022, and they bought those bridge facilities on pro forma, and you're about to find out why. So let's talk about market cycle fundamentals. We pretty much here all know what the different phases are. Phase 1 is recovery, 2 is expansion, 3 is oversupply, or Dr. Muller calls it hypersupply, 4 is recession. So here's what it looks like. I created this chart myself. This is mine. So we have recovery and we start coming up in recovery. Down here in recovery, we have negative rent growth. You're still declining in occupancy. Here's your long-term occupancy average. I know it says vacancy, but let's use the inverse of that. This is your long-term occupancy average here. This is your net operating income here. So as your occupancy increases, your NOI increases. It just does it by nature. More people, the more butts you put in the seat, the more money you're going to make. Whether you have rent growth or not is irrelevant at this point, because for every new unit you rent, you're increasing your NOI. So as we get up here into recovery, let's call this 2010. Let's call this 12, getting into 13, and then in 14, we started seeing new development. And I'll talk about this in a second. So right about here is where we finally start to see some positive rent growth. Occupancy is continuing to increase. Now it's accelerating. Here we get past that long-term occupancy average, and CoStar has a great infographic that shows what the market's long-term occupancy average is. As the NOI continues to go up because rents are climbing and occupancy is climbing, now we get to a point where the NOI will support new development. So right about here was about 2014 to 2015 in multifamily. We started seeing new construction. Couldn't afford it until then. The new construction at that time, because it was so expensive to get lumber and prices were already starting to go up, Class A was all that was being built during this time. As we continue to grow our rents and we continue to go up the cycle, our occupancy continues to go up. And about this point, we start delivering units. So as we start to deliver units, now absorption starts to take over. And so we're putting more units on the market than the demand for the units can handle. And when we get to the point of equilibrium, this is where demand and supply are equal. So now the number of units that are entering the market and the amount of absorption it is taking to absorb those units meets at this point at equilibrium. But the market continues. Sometimes it'll bounce back and forth, and we see that quite often. But for the most part, it continues to track down. So now we're still showing rent growth year over year. We are starting to see occupancies dip because there's more space on the market than there are renters renting the units. And then it starts to accelerate a little bit. And as it gets back down to that long-term occupancy average, it dips below. Now we're starting to see negative rent growths. We get down into the recession, and from long-term occupancy average to the bottom, back to the bottom, typically is a short period of time. Now, we've seen that over the last, good Lord, 13, 14 years, that we've had a very, very, very long expansion, longer than we've had in the history of our country. Does that mean we'll have a longer oversupply and recession? I don't think so. Usually when you get to a point where you're in the recession cycle, it's going to happen fairly quickly. Some markets will recover faster than others. The way you know whether a market will recover faster or not, I'm going to use Dallas as an example because I'm going to show it, and a lot of you are from Texas that are here. If there is economic strength, we know 100 people a day are moving to Dallas. If 100 people a day are moving to Dallas, why can't absorption keep up with deliveries? That makes no sense, but it does. If you think about it, rents have gone so far beyond median household income, people can't afford the units anymore. So now they're roommating up, or they're moving back in with their parents, or their brothers and sisters, or cousins, aunts, uncles. Everybody's just kind of moving in together, kind of like we saw in 08, just not as bad yet. But they're roommating up so they can afford these units. That affects demand. So even though we have this economic strength in Dallas, they can't afford the units. So you're peaked. Dallas is peaked at where the rents are, and we've already seen them go down, but now they've slightly dipped up again. I'll show this to you in a little bit, but you're going to see that the demand, which is absorption, the demand from the renter says you should be reducing your rents, not increasing them. But yet we're seeing slight increases quarter over quarter from fourth quarter to first quarter, which is really interesting. And I'm not going to try to guess why. I'm thinking it's because NOIs need to grow because there's a bunch of properties in trouble, but we won't assume that, even though I like to assume that. But fact of the matter is, once we get into recession, it goes fairly quickly, but you're going to find that Dallas has a whole lot of inventory to get through before they can come out at the bottom of this thing. But they'll recover quickly because they have economic strength. Does that make sense to everybody? Anybody got any questions on that?
No, I think I was just having some questions about the new supply, and making sure that we all understand that the new supply doesn't last very long in terms of the quality of it. And that's what's a challenge for Dallas, is because then, in the next cycle, which is, maybe 5 years, that now is old. The new, it doesn't last as long as in other markets, that new inventory. It's not a class A for as long as some of the other markets. And so you end up having to reduce your pricing, even though it's still a class A. Then the next best asset, that new class A that just came on, is even better. So we're seeing some reduction on those that new inventory.
Right. But you're going to see reduction right now, primarily because of absorption not keeping up. Because right now there are more Bs being delivered in Dallas than there are As, because the rents are high enough that you can afford to deliver a B class property, which gives a developer a higher return on their capital. So here's Dr. Muller's fourth quarter report. Don't know if you guys have seen this yet. This came out a couple of weeks ago. He's got about 7 markets that are sitting right at equilibrium. Nothing is in expansion. He's got just about 80% of all markets sitting between 12 and 13 in the hypersupply phase, to include San Diego in 0.12. Dallas is sitting here at 0.13. And Austin is sitting here on 0.14, so hitting that equilibrium point. And then in Phoenix is the only one sitting actually in in recession, with Riverside, Salt Lake, Seattle, Sanford. They're all at 0.14. Okay, so Austin, Sacramento, Atlanta, and Riverside, all the way down to the nation, are sitting here on the long-term occupancy average. Phoenix, the only one here at 0.15. Does he have? Yeah, he's got Las Vegas up here. So he's moved well, he's got Las Vegas didn't move. If you see +1, that means it moved up one spot. If you see a -1 like Palm Beach, it moved back one. All right. So that's what that means. Okay. So this is where Dr. Muller says everything is.
Can you just tell us who Dr. Muller is for those folks that don't know him?
So Dr. Muller is an economist that is a professor at the University of Denver at the Daniel School of Business. As a matter of fact, I will put this in the chat for you guys. So let me go here. Bookmark. Oh, no, it's down here. I can go here. This is my fastest way to it. Right there. So if you go to the bottom of this website, this is the Burns School of Real Estate, scroll all the way down and come up just a little bit, you'll find Dr. Muller's market cycle reports. He gives the current reports. Oh, he's got the first quarter 2023 out already. I should have looked before I came on. Let's take a look at it. We'll see it here in just a second. That's fast. He's never produced a report that fast before. He also has his reports where he does forward looking. So if he's just done the first quarter 2023, he'll also have available his first quarter 2024 prediction. You have to pay for his prediction reports. The current reports are free. It goes all the way back to 2019. So let's take a quick look at see what multifamily is for. All right. Well, so he's moved Phoenix back one, and this is because we saw some rent increases from fourth quarter to first quarter. So he's kind of moved everything a little bit, but he's got just about the entire country. He only does the top 53 markets, but he's got about 45 of the markets in hyper supply with Washington, D.C., the nation, and these markets sitting on equilibrium. Okay. So that's where it currently is. So not much of a change, but interesting that he's got it out already. So yeah, here rent growth increased nationally by 1% in the first quarter 2023. And I've seen that as I do my market cycle reports that I do on YouTube, which I haven't done in a couple of weeks. I got to get back to doing those. So interesting. Anyway, let me grab this. You guys can check out his website and pull these reports for yourself. They are really good reports. But again, they are only for the top 53 markets. All right. So this is what it looks like in the stock market. Not much different than our market cycle, but let's take a look. So down here in recovery, we're in disbelief. This rally will fail like all others do. So these are stock market investors. As it starts to go up, they're like, oh, hope. Well, maybe a recovery is possible. And they let it continue to just kind of drive on up. And now optimism kicks in. Oh, maybe this rally is real. And then it really starts to climb in belief. Time to get fully invested. So boom, we start buying here in belief. And then it gets up to the thrill ride. I'll buy more on margin. Got to tell everyone to buy. And we ride it all the way up to euphoria at the peak. And then things start getting volatile, as we know the markets will do. Today, it was down, 300 something points after being up all last week. So it gets volatile. So it's bouncing up and down. And then complacency sets in. We just need to cool off for the next rally. And it starts to come down real volatile. Then anxiety kicks in. Why am I getting margin calls? This dip is taking longer than expected. And then it's denial. My investments are great companies. They're blue chip stocks. They'll come back. And then panic sits in. Oh, damn, everyone's selling. I need to get out. And then so where we bought in here at the top of the market, everybody that's been buying since 2019 through 2022, now they're selling down here at the bottom of the market. Then capitulation sets in. I'm getting 100% out of the markets. I can't afford to lose anymore. And then you start getting angry. It's like, who shorted the market? Why did the government allow this to happen? And then, of course, it just kind of bingo bongos along down after it goes through recession, comes up to the recovery again. Depression sits in. My retirement money is lost. My dog dies. My wife left me. I crashed my truck. And it starts to go back up again. And now it's disbelief. This is a sucker rally. All right. So not much different than what we see in multifamily. So right now, everybody's kind of living right here. But there are some folks that are already seeing where their loans are coming due very, very soon, and they are at what they have what are known as at-risk loans, and I'm going to talk about those in a minute. So there's some anxiety setting in, and there may even be some denial setting in, because as I'm also going to talk about, there is this belief, and I don't know where it's coming from, that the rates are going to go back down again. That's denial, folks. If that's what you believe, you are living in denial. Okay. So we have definitions for each of our phases, and then there are solutions for each of these phases. So for recovery, that first phase, this is a period of reinvention. You start to create a new business model because the old business model may have gotten real bad and we need to reinvent ourselves. Diversification of risk starts to take over. We've got a renewed customer focus. Cash is king down here because sometimes the lenders kind of don't want to loan down in this part of the market cycle. We're focusing on fundamentals, and we're as we've been consolidating, and you'll see that as we get into the crisis phase. Consolidation is accelerating at this point. So what are our solutions in the recovery phase? Well, we got to build our pipeline. We got to rebrand, accelerate value add acquisitions, buy. Start to initiate development. We actually don't start building until we get up in the expansion phase, but we're starting to initiate that development because we know that occupancies are now increasing and NOIs are increasing, so we can start thinking about development. We expand our offerings and we reposition our assets. As we get into the expansion phase, this is known as the growth phase. This is period of opportunity. We've got rising occupancy levels, rising rents, growth in NOI, increase in asset value, development activity is now happening. There's available capital. And oh, look, shocker, new competitors enter the market. So what are our solutions here? Okay, we expand vertically, we expand geographically, we expand our customer base, we invest in infrastructure, we expand adjacencies, and we leverage our capital platform. Expanding adjacencies means that you're expanding those properties around you. Okay, that's an adjacency. All right. Just so you guys know, I did not make this up. This is directly out of the CCIM curriculum. This is what 135 universities across the country teach their postgraduate real estate students. This isn't mine. These are fundamental principles. All right. I want to make sure you guys understand that. This isn't a tactic. These are fundamental principles. Plateau phase, kind of where we're sitting right now in the real estate cycle. This is the oversupply or hypersupply phase, as Dr. Muller calls it. This is a period of decision. Tell me if you guys recognize any of this. We have a supply-demand imbalance. A whole lot more supply than we do demand right now. Optimistic underwriting. Julie, you seen any optimistic underwriting lately? Julie, am I still here?
Yes, absolutely. Sorry. A lot of optimistic underwriting. Yeah.
Yeah.
But I've seen it not as glorified as I did, about 10 months ago.
Right.
So it's coming down.
How about unrealistic asset values? Every day. Generous TIs. So for those that don't know, in the commercial real estate world, TI is called tenant improvement for like retail, office, industrial. In the multifamily world, we call it unit renovations. Okay. Rent concessions are happening. There's high investment activity still going on. This is the plateau phase. This is kind of where we are. We see all of this prevalent in our market today across the country. What is your solution here? Now pay attention to this, guys, gals. You start to dispose of your non-core assets. I see a lot of people right now where their core asset is multifamily in Texas. So what are they doing? Because it's harder and harder to find multifamily. They're expanding, not disposing of non-core assets. So they're going after self-storage units or mobile home parks or RV parks or hotel conversions or build-to-rent communities. And they're trying to diversify at the wrong time in the market. This is the time where we dispose of those non-core assets. You want to lock in, what's that say? Long-term debt. That doesn't say short-term bridge debt. Long-term debt so that you can make it through what's coming. Okay, the storm is sitting in the Gulf right now. That hurricane is sitting in the Gulf. I'm going to show it to you in a minute. It's coming, make no mistake. And if you have short-term debt, you're in a lot of trouble. Build third-party work. This is mostly for brokers. You can't rely on transactions. You're going to have to do some kind of consulting business or find something else you can do while transactions are down during this period. Start to accumulate cash, because in the next part of the cycle, when all the foreclosures start to hit, cash is going to be king. And of course, we downsize our non-core markets. I should say markets. I forgot to put it in there, but that's what that is, downsized non-core markets. So if your core market is Texas and you're investing in North Carolina, you want to start downsizing your North Carolina assets so you can focus on those core assets. And here's where we're headed.
I do have a question in the house. Ruben wants to find out, do we really have an oversupply of apartment units?
Okay, I'm going to show you. How about that?
Okay.
My God, do we have an oversupply? Oh, yes. Okay.
Well, we're building here in California because we have a shortage of people.
Here's the problem. What's happening is you're hearing in the news that there are 3 million, we have a demand for 3 million rental units in the country. That's what we hear in the news. And so everybody believes that there's demand everywhere you go, and it's just not true. And again, depending on what your rents are, remember, the renters set the demand. The renters set the demand, and we can see it in absorption. I'll show it to you in a minute. You're going to see it with your own two eyes. The renters set the demand. When the renters are not renting, when absorption, and here's a quick definition of absorption. Absorption is beginning of year or beginning of period, because you can do it quarter over quarter, month over month, or year over year. Let's just call it beginning of year. Beginning of year, end of year occupied units, end of year occupied units, not all units, just occupied units. End of year occupied units minus beginning of year occupied units equals absorption. That number can be positive or it can be negative. If it's positive, it means that there were more units rented in the market than went vacant. If it's negative, it means that there were more units that went vacant than were rented during that period. And that number by itself doesn't mean a lot without looking at deliveries. So if we had 15,000 deliveries, but only 5,000 absorbed, you've got declining occupancy. Demand supply principles say that when occupancy declines, rent declines, because most fundamental investors know that the most important thing in investing is butts in the seat. You focus on occupancy first. So in order to fill those units up, you have to lower your rents. So when occupancy starts to increase, rents should decrease. Now at a certain level, and I'll show that to you in a minute. Make sense to everybody? Those are demand supply fundamental principles. Okay. So let's get into the recession phase. This is a period of change. Rents are now declining year over year, month over month. They are declining. There's little development going on, limited access to credit. You start deleveraging, because if you're over leveraged, you are probably giving your property back to the bank. There are declining asset values. We're already seeing that. Workouts and restructuring. If you bought right, you have the ability to do a workout or a restructure. If you did not buy right, you're going to be in a lot of trouble, and entities start downsizing at this point. Okay. What's our solution in the recession phase? Buy. Interesting, isn't it? Acquire underperforming assets, acquire necessity real estate, and acquire market share, customer base, and talent. Now, we're hearing from gurus that this is the best time to be buying real estate right now. That's in this phase. That is incorrect. The best time to buy real estate is in this phase, in that crisis phase. Okay. As the asset values decline, you buy it right so you can survive a little bit longer, and then it's going to come back up. All right. That's how you buy. Where Warren Buffett is buying, let's go back to the market cycle. Warren Buffett's buying right here. Sam Zell, prior to him passing away a few weeks ago, he was buying right here. David Monroe is buying right here. Okay. Not here. Not here. We got people still buying here. And if your risk says you can buy there, that's great. If you understand the fundamental principles. Problem is, most people were not taught fundamental principles. They were taught tactics. And the tactics they were taught work in the expansion phase. They do not work on the backside of this NOI line. They only work like David Lindahl. Let's take David Lindahl, for instance, RE mentor. David Lindahl teaches some good stuff. His big thing is the Holy Trinity. The Holy Trinity only works down here in recovery. Once you get into expansion, Holy Trinity is gone for quite some time. We may see Holy Trinity come back again, but that's where it works. Everything Sumrock teaches today, that works in expansion. We've seen it. People have been very successful in the expansion phase. Guess what? We're not in the expansion phase anymore. We're in oversupply. There isn't anybody teaching fundamental principles that will survive through oversupply and recession. Tactics do not work in oversupply and recession. At this point, we need to start using fundamental principles so that we can survive. Does everybody understand that?
Yeah.
All right. So basically, we got to get back to the basics. The property must be cash flowing. You should not be buying value-add investments. Day one, when you take over, then that day, you should have a debt service coverage ratio with your debt on current financials of at least a 1.4 DSCR, because that still allows you a little bit of room to go down because rents are declining right now. Where rents aren't declining, they are going to decline. Okay, we are going to be entering this recession phase soon. And so you've got to be able to weather the storm. So if you're buying, you should be buying at a 1.4 DSCR as it sits today, not 2 years from now when your business plan is done. Today, that is a cash flowing asset. You can buy a cash flowing asset and survive. The debt must be permanent, not bridge. Bridge will kill you. Get permanent financing. Going in cap rate must be above the interest rate. I'm going to say that again. Going in cap rate must be above the interest rate. Who can tell me why? Why does this matter?
Roger?
I know, Roger.
You would have negative leverage if you had it the other way around.
That is correct. So let me give you the best example. And I saw somebody, and he's a nice guy. I like him a lot. He lives in the middle of the country, and he's just the nicest person in the world. And he's gotten involved with some syndicators down in Texas. But he is teaching leverage like I've never seen. As a matter of fact, that it doesn't make any stinking sense whatsoever. Let me tell you what leverage is. The basic principles of leverage. Leverage gives us the ability to utilize folks like Julie to provide up to 75, 80% of the capital so that we can have a greater return on our investment. We're using less of our money. We're leveraging the lender. Well, that lender has a cost. That cost is a cost on operations. We have to pay that lender back during operations. So that's our operations cost for borrowing that money. When we purchase the property from a seller, there's a cost to purchasing that property on the investment value. That cost is the cap rate. When the cost to purchase the property is less than the cost to operate the property, you've lost your ability to have leverage. You'll actually have a lower return for the same amount invested than you would if you would have bought the property for cash. You've lost the ability of leverage. So when I see people say, and they tell their investors, get the advantage of leverage through debt, yet we're going to buy it at a 3.5 cap rate and our loan is going to be 6%. They have no idea what they're talking about. They just lied to their investors. If they put that in their PPM, they're now at risk of fraud. You've got to understand what the principles are. Okay. Sorry, I told you I get on my soapbox. I apologize for being so abrupt, but then again, I really don't. It cannot be an appreciation play, which is why it must be a cash flowing play. Okay. So that is the PowerPoint. Now, I want to, oh, hold on. There we go. I want to go into CoStar. This is today. All right. Here is that long-term occupancy average. This is occupancy down here in the bottom. Okay, everybody see this okay, or do I need to blow it up a
Yeah,
little bit?
it looks good here.
Okay. You can see that this is over the last, because CoStar goes back to 2000. They go back further than any other supply side tool. So they go all the way back to 2000. You can see that Dallas is sitting on the long-term occupancy average. Now this is for all three asset classes, A, B, and C. Okay, this is all of them. So it is sitting on that long-term occupancy average. There's 848,794 5 units in the market, 6,193 properties. These are market rent properties. These are not low income. This is not senior. This is not student. This is only conventional apartments. There are 59,926 units under construction. Can somebody say, oh, shoot? Say, ruh-roh, raggy. Now, 12 months prior, 25,000 more units were rented than went vacant. But in the last 12 months, only 7,400 more units were rented than went vacant. It has decreased by 71.2%. There has been a major slowdown in demand. But wait a minute, David, how's that possible? 100 people are moving to Dallas a day. It's because your rents are stupid. The median household income does not support these rents. That's why. Okay. Now I have a video on my YouTube channel where you can go see how to see if your rents will support the median household income. It is not a simple calculation. It's the same calculation that FHA uses to qualify a mortgagor. Okay. Vacancy has increased from 6.4 to 8.7 in the last 12 months. And for the first time, Dallas is now showing a year-over-year decline in rent. But wait a minute, everybody says that Dallas rents are increasing. How's that possible? Here's the data, folks. Data-driven approach. I'm not lying to you. I'm showing it to you. Okay, this is the capital market. We don't look at this, but look at the wait, look at that. Look at that drop in price per unit from 202 to 189. Well, wait a minute. Prices aren't going down in Dallas. Oh, yes, they are. But we don't look at the capital markets in this case. We only look at the space market. All right. There's our long-term occupancy average. Let's look at the data. So you remember I told you that absorption drives the bus. Absorption is our indicator for renter demand. So if we come all the way across, we can see the amount of deliveries. Okay. So if we look over the last 12 months, so let's just go back from where CoStar has it here. We got 5219. Well, let's pull out the calculator. Julie, how much time do I have?
About 6 minutes.
Ooh, okay. All right. 5219 plus 8358 plus 4821 plus 9952. All right. You remember that 7,000 units that it said it's absorbed in the last 12 months, but it's delivered 28,350 units. What do you think that does to occupancy? It tanks it. So looky here. Here's occupancy. Occupancy was 93.5 in the second quarter of 2022. Went down to 92.5, down to 91.8, down to 91.3. Yet, even though it went down, we can see that rents increased. That is against demand supply fundamentals that say the owners and the managers are playing hardball. They are driving rents up, yet there's no demand to drive these rents up. Brokers won't tell you this stuff. Brokers, if you're on here, you need to start being honest with your folks. Can you sell property this way? Probably not, but at least you're building for the next cycle. All right. So this is Dallas. Dallas is declining, folks. 91.3 is right on that long-term occupancy average. All right. It is on its way down. I would place Dallas closer to the long-term occupancy average than Dr. Muller did, primarily because we are sitting on that long-term occupancy average, but he's taking into consideration that they had that rent bump in the first quarter. That rent bump was an anomaly. You're not going to continue to see that. It is going to start going down. All right. So that's what Dallas looks like. So I want to show you this. Interest rates. Tell me in the chat or raise your hand or whatever you want to do. I'm going to open this back up again so I can see everybody somehow, some way. Where did you all go? There you are. So let me move you over here. Who believes interest rates are going to go down by the end of the year?
No.
Do you want me to close your sharing?
Huh?
Do you want me to close your sharing so you can see everybody?
No, I'm good.
Okay. Okay.
Everybody. I'm good.
Okay.
Where'd my chat go? I lost my chat.
Okay. So the question is,
There
who
it is.
thinks that the
No.
interest?
Yeah. Who thinks interest rates are going to go down at the end of the year? I know that's what everybody's being told.
Mm.
Who believes that? Everybody's saying no way, not. Okay, good. Right here's your proof, folks. What's the long term? Okay, Freddie Mac started keeping track in 1971 of the Fed fund rate. Since 1971, the average fund rate has been 5.42. Where are we right now? At 5.25. What did the Fed say last week? We are probably going to increase 2 more times at 25 basis points. So we're somewhere around 5.6, 5.7 by the end of the year. Okay, we're right where we should be. But there's belief that rates are going to go down. All right, now you need to see this because this is disturbing. This is a report by TREP, and I know Julie knows who TREP is.
Yeah.
TREP reported on refinance risk assessment for multifamily properties for at-risk loans. So if we look at at-risk loans by property type, multifamily holds 42%, 42.3%. These are at risk in the next 24 months. All loans coming due in the next 24 months. 37 billion are at risk in the next 24 months. What does at risk mean? Where'd it go? I know I highlighted it. I forgot to highlight that part. Oh, it's right here. The success of projects underlying commercial real estate, CLOs. That is a commercial loan obligation. In other words, bridge debt. Could be at risk if the loans show any kind of distress and are unable to exercise extension options, refinance, or sell the property at a high enough price to extinguish all debt and ideally recover some amount of equity. Okay, so they're at risk of all of those factors. They're at risk of refinance. They're at risk of getting an extension. They're at risk of being able to sell their property, primarily because of debt service coverage ratios. We'll look at that in a minute. Of the at-risk loans, 63.5% are CLOs. 63.5% are CLOs. 23.574 billion of CLOs, bridge debt. Now, here's the most disturbing one. Maturing multifamily loans by debt service coverage ratio. 23.48 billion have less than a 1.0 debt service coverage ratio right now. What do you guys think the foreclosure market's going to look like in the next 24 months? You preparing for this? You guys preparing for this? There's going to be a ton of opportunity. Okay. Now, I'm creating a marketing campaign that's going to try and help some of these guys because there are options. They do have options. It's not going to fix their NOI, but it may get them to at least stop a foreclosure. Some of their investors are still going to lose. They're going to still lose, but at least they can stop the foreclosure. So there are options. So I'm working on trying to get a hold of a bunch of these folks to try to let them know that. So it was very important that you see this. My whole point of this is we are heading down a path that is very dangerous. And I'm going to close with this. So in 1985, I lived in a little town right here in the toe of the boot of Louisiana called Bogalusa, Louisiana. And we got hit by Hurricane Elena. And Hurricane Elena, if you were around and remember the Gulf Coast hurricane season in 1985, it came into the Gulf and it essentially just kind of sat right here for a while. It was like 3 days. It just sat right here and just spun, gained strength. And then it started to trek towards Panama City. And then it started to trek towards Tampa. And it got right here as a category 3. And it said, you know what? nah, we don't want to go there. It churned and went right up through Biloxi into Picayune, Mississippi, and right into Bogalusa, Louisiana, where I was. We saw the eye of the hurricane. Very interesting. First time I ever saw a hurricane. Right. This is kind of what our market's doing to us right now. Right now, we're just sitting here spinning, wondering, what are we going to do? All right. And it isn't going to be long when the market's going to tell us, all right, this is the direction we want to go. It may trek us a little bit of the wrong direction, but then it's going to correct and boom, we're going to take off. We're going to hit that recession and we're going to correct what we've been seeing, the stupidity we've been seeing for the last 3 or 4 years. And prices are going to come back down to where they should. Rents are going to come back down to where they should. And we'll be happy for at least the next few years until it all goes crazy again. And it will, because it does every cycle. So I would like to thank, I have a little slide here, but I got to get it back up. There it is. I would like to thank everybody for listening to my psychobabble. And I'm sure this is where Julie has her Q&A.
Yes, before we go to Q&A, in case somebody has to leave, how does somebody get a hold of you? I want you to take 2 minutes. Talk to us about your strategic partnering program. I think it's very, very important. People are going to be like, how do I find him? How do I get a hold of his program? Tell us a little bit high level on that.
Okay, so again, I teach fundamental principles. So I have a community. I created this community because I went to a guru event, and I won't call Sumrock's name out. I won't call his name out, where in the first 1 hour, he told everybody it's okay to overpay for the property. The market will come to you. And I blew my gasket. I wanted to come through my screen. I was on virtually. This was March of 21. So I said, originally I was just creating an education company where I was just going to provide fundamental education. At that point, I said, I'm going to build a community. And so I started the strategic partnering community, and you can go to strategicpartneringcommunity.com to get information about it. And we've been going now. We launched April of 2021. We've been going strong. We have 286 members right now. It's gone through a bunch of different phases. I've got a 14 module workshop that literally begins with the end in mind, setting your goals, determining what roles you want to play, takes you through the entire transaction process, all the way through to operating the property and asset management to disposing of the property on the backside. I left nothing out. Everything I've learned in the last 13 years is in that course. There is nothing else to teach. That is it. That is the fundamentals. Okay. That course. So that's available in there. There are some other small workshops that are in there. The community's in there. We have a whole bunch of Sumrock members that are in our community because they come to me for the education. They go to him for the network. I've got a bunch of Lindahl people. I've got a couple of Michael Blanc's people. I've got a couple of what's the guy's name in Orlando? Rod Cleave's people.
Jake and Gino's.
Yeah, well, I don't think we have any Jake and Gino folks, but I like what Jake and Gino do because they teach you to go small first, not big.
Yes.
Okay.
Correct.
So I like that. I like that about those guys. And I've been to one of their conferences. They had a pretty good conference. And Julie, you and I saw each other in Orlando once, remember?
There you go.
So David at davidmonroeccim.com is my email address. Strategicpartneringcommunity.com is, and you got to put www in front of it. That is the website. If you want to learn more, you can learn more. There are 4 or 5 people that are strategic partnering members inside this call right now. You guys feel free to chime in and chat. Don't take up the time on audio, but if you want to chat of your experience, you can put that in there as well. And I really, really, really appreciate you letting me come on. You and I have been wanting to do this for some time.
Yeah, this is great. Well, let's open it up. If anybody has a question, let's take 3 questions if we've got them. Let's take 3 of them. Raise your hand and let's ask the guy who's going to tell you like it is.
Let's ask the jackwagon.
Do you invest yourself, Dave?
So my last one I was invested in. I was a passive investor. It closed in March of 2020. I was a strategic partner on that one. I brokered the deal. It was a foreclosure. I sold it to a group of guys out of Pensacola. I invested with them on that deal. And again, we sold it March of 2020, and that was my last active apartment investment. Since then, we've sold all our mobile home parks. I had one single family home, sold it, and I've reinvested everything into my education company because the market's been too stupid for me. My risk does not allow me to invest on pro forma. I never will. I refuse to do it, but pro forma is going to go away for a little while. Fundamental principles are going to come back, at which time I will be passively investing with my members in the strategic partnering community, because what a better way to vet a sponsor than to teach them.
Oh, fantastic. All right, Lucia, what do you got?
So how do you feel, how are the foreclosures, how are these properties going to come to market?
It depends. If it's agency, they must come back with a broker. That's mandatory. Federal government requires it. If it's not agency, it's up to the lender. They can do just like Arbor did on the Houston foreclosure. Arbor took the properties back at the loan amount, turned right around and sold them at 80% value to an institutional firm. I think they were out of California. Julie, you remember where they were out of?
I don't know. Yeah.
Yeah, for 80 cents on the dollar. So a lot of your bridge lenders will probably do that. But they're going to go, those big ones like that are going to go to institutional firms. They're not going to go to small time syndicators. But a lot of them will come back on market.
Thank you.
Anderson, what do you got?
Hello, good evening. First of all, thank you for the amazing content, David and Julie. Really, really appreciate it. David, at one point today, you mentioned that some properties or you mentioned the properties will survive because they have economic strength. Can you expand a little bit on that versus this, I guess I would say, call it the second part, where you said, you know, there's going to be a lot of foreclosures?
So
I'm just not clear on that part.
We make our money when we buy, not when we sell. And if you bought on pro forma from 2020 to 2022, if you bought on pro forma and you bought with short-term debt and you bought it at a variable interest rate, you're probably not going to survive. Good chance you're not going to survive. You're going to go into foreclosure if you can't figure out a way to get out of it. There are solutions, but most people don't know what the solutions are. Matter of fact, Julie, what's his name? Neil Bawa had some great solutions on Old Capital's monthly call a couple of weeks ago, wasn't it? 3 weeks ago?
Oh, probably a month ago. Yeah.
That's one of the best classes. And I'm not a big Neil fan, but that was one of the best classes I saw Neil give. That was a good one.
Yeah.
He had some great solutions and they were right. His data was a little off, but that's okay. We can all be off. It's a matter of interpretation. So if you buy it for cash flow and you buy it under fundamental principles, not pro forma, then you can survive a recession. But you've got to buy with some cushion. It's where you got to buy right.
Reserves?
Today, not necessarily reserves. Reserves don't help your NOI. Reserves just help you pay the debt. When the NOI drops far enough to where it goes below your debt service coverage ratio, your lender gets really nervous.
Mm-hmm.
And they have a clause in the contract, in your mortgage, that says, if your debt service coverage ratio drops below our minimum, thank you very much.
They can call it.
Calling the loan due. And they have every right to do that.
Or they'll go into management, cash management.
There's a very good chance that once it does drop, it is going to go into special servicing. Because once it goes into special servicing, and you can't really do a workout until it goes into special servicing, if you have the ability to do a workout, then you can start negotiating that. That's why, if you heard recently, Blackstone took their New York trophy portfolio a couple of months ago, and they asked for those properties, because they were below their debt service coverage ratio, they asked for them to be pushed into special servicing so that they could start getting loan workouts for those, defeasance basically. But if you've already had a defeasance because of COVID, you may not be able to get another one. Now that's case by case. That's not all the time, but typically you don't get two, you only get one. So you got to buy right. And buying right means cash flowing day one, and your debt service coverage ratio should be about 15 basis points above what the lender minimum is. So the lender minimum is 1.25. You should be buying it with a 1.4 day one, not 2 years from now when your business plan is complete. Day one, then you can survive. If you buy it with more risk than that, you buy it right on that debt service coverage ratio, then you're going to be at risk. And like this lender we saw when I first started the presentation, we saw that email. There is no debt service coverage ratio requirement. What's that guy smoking? That's just asking for trouble.
Thank you.
All right.
Yes,
Yeah.
sir.
Any one other one, if there's somebody here, you're in the live conversation, you're in the room with our industry expert. It's your opportunity. What do you got? Anybody? Bessie?
I love a
Annie.
contradictive argument, honestly, but sometimes I don't get them.
Right, man.
Hey, David, thank you so much for the
Hey.
content. Really cool to hear you speak.
Yeah.
And thank you, Julie, for putting this together. I had one question. I know a lot of the information you shared today was pertaining to the multifamily kind of vertical.
Mhm.
Would you say this same thing applies to the commercial side in terms of like office buildings and all that? And I'm just asking that question because there's a lot of anxiety here where I reside in the Bay Area. And there's been a couple of trophy properties that have kind of been either returned to the lender and or are being asked to be returned. So one of the recent ones is the Westfield Mall here in downtown San Francisco. And I was just curious if some of the data that you showed also kind of covers that part of kind of the vertical, if that makes
So
sense.
What I've done is multifamily specific, but I
Right.
grew up in Santa Clara, Manny, so I know where you are.
Okay, cool.
Office is in a lot of trouble. They're in
Yeah.
worse trouble than multifamily is. They're the worst.
Okay.
Big time.
Trepp came out with a big report today. Now I deleted the report because I don't do office, but the delinquency rate and the special servicing rate is higher than it's been since 2012 for office. So they are in a lot of trouble. They're worse than we are.
Big time.
But I would imagine based on the CCIM kind of criteria, the same fundamentals apply, right?
Same fundamentals apply. Yep,
Right,
that
okay.
fundamental principles apply across all asset classes.
Gotcha.
What I've
Okay.
shown you today with the market cycles is across all asset classes.
Perfect. Okay. Thank you so much. I appreciate it. Huh?
Yes, sir.
All
Good
right, well-
question, man.
Well, okay, everybody, we are out of time. We have to get to our next set of Zoom at 8 specialty, which is networking. So David, thank you for all you do. You have so much information to share. We've got to get you back. I think, you just add so much depth and conversation and knowledge and, the whole thing. So I'd love to have you back on. It'd be great if you could come quarterly, but I want to thank you. You're
Me
special
too.
to us. And Anderson would like to come back too. We'd like to have Anderson
please.
come every week. So anyway, David, thank you so much for everything.
Thank you.